Hello, from LPL Financial, welcome to The Talking Point. I'm your host, Quincy Krosby. Good morning, everyone. This is Quincy Krosby. It is Monday morning, December 4th, and this is The Talking Point. Thank you for joining me. The market is just about open this morning. It is in the red. Quite frankly, this market needs to consolidate to rest. We like to see markets literally pull back a bit and allow some of the froth, some of the gains to just rest, be digested. It doesn't have to be a deep sell-off. It could be a market that is sideways, a market that meanders into positive territory or then pulls back a bit. But nonetheless, you want to see, especially in the month of December, start to ease a bit, rest a bit. Notice I'm not saying collapse a bit, but just rest. We don't want to go into 2024 with a market that is so completely overbought. That would not be a good thing because the market, has to digest new money coming in. You're going to see money coming in January. That money has to be placed. But the fact of the matter is, if the market is so overbought when we go into December, does this rally take away from the gains that we could see in early 2024? So for many reasons, it would be helpful if we see this market just ease up a bit. So keep your eyes on it because this is something that would be positive, not negative, not, cause for worry. It would be normal. It would be healthy. Now, as far as last week is concerned, I was heartened by a couple of things. I saw the Dow transports do well. The Dow did well. How about that? The Dow did well. Some of the Dow, Boeing, for example, did well. A number of the tech names did well. But the point is that what the transports is always maybe sounds old fashioned, but the fact is the transports carry things, do they not? And when they do well, I think it's a good sign. I am a big follower of the semiconductors. I want them to do well. The Philadelphia SOX Semiconductor Index, I want that to do well. Obviously, the chips are in everything. You want them. They are a leading indicator. But let's not forget about the Dow Transport. So it was good to see them do well. The Russell 2000 also gained. Now, this is extremely interesting because one of the primary reasons for that is a component of the Russell 2000, which are the banks, the small banks. Now, that is positive news if it can continue. The Russell 2000 also is home to industrials, to biotech names, and to small technology names. But the two biggest components are the banks and the industrials. Then when that does well, it bodes well overall for the overall market because they are granular. I always say that. The Russell 2000 is granular. It is at the core of our economy. And that's why, absent even looking at the components, but just looking at where the Russell 2000 is in terms of participation in the broader rally, it tells you a picture of what that index sees in terms of the economy. That's why I pay attention to it. And when it is participating in a bigger rally, stronger rally, it's telling you that the Russell 2000, embedded in the, again, granular economy, still sees a constructive backdrop, economic backdrop, because the Russell 2000 would have no qualms about selling off if it sees an impending recession. So let's keep that in mind, because the market right now is focused on, obviously, 2024 and whether or not the Fed cuts rates. The market is convinced that the Fed is going to cut rates. In fact, you would argue that this rally is based on, one, that the Fed has finished raising rates, and two, that the Fed is going to cut rates in 2024, at least by mid-2024, if not earlier. You have to then question what would have the Fed cut rates? Why would they do it? What would compel them to cut rates even in the summer of 2024? Well, it would have to be that the Fed is worried about a significant slowdown, or the Fed is worried about liquidity drying up in the market. Remember, that's one of the reasons the Fed typically comes in when something breaks, because that is when liquidity dries up. And people always say, Quincy, what is liquidity in the market? What does it mean? I'll tell you what, it is the oxygen for the market. We all can say the housing market back in 2008, right? You couldn't sell a condo for love or money, or a house back then. Why? Because liquidity in that market actually dried up. And then you remember the Fed came in and tried to help bolster the economy with quantitative easing. But the point here is that the market is seeing that the Fed is going to need to come in, right? And the Fed is, Chairman Powell said, no, we're not talking about cutting rates. That is not on the agenda. Well, the market is saying, well, sir, with all due respect, that's not what we see. So in any event, as we come toward the end of this year, I want to go over a couple of important things. The Santa Claus rally, right? That's the important right now, don't you think? The Santa Claus rally. What this is, it comes from an analyst, I won't go into it in this call, who back in 1972 coined the term Santa Claus rally. It focuses on the week leading up to Christmas, the week leading up to Christmas. Keep that in mind. It's the trading week that leads up to Christmas, and a couple of days at the beginning of January, the trading days at the beginning of January. That it has a tendency, about 76% of the time, to offer about 1 to 1.2% gains, a positive tilt, but not 100%, but a positive tilt about 76% of the time. You may remember that last year, the market was, where's Santa Claus? Every day, where's Santa Claus? Did he get stuck in the snow? Is anyone helping him? What happened to the reindeer bringing us that rally? Finally, we had it. It was a little bit delayed, but we had the rally. It has to do with new money that is going to come into the market, and many managers sometimes come in earlier to place money, knowing that they will have money that has to be allocated in January. It also has to do with tax harvesting and ending of the tax harvesting. It also has to do with volume in the market comes down that week, and if the market's tilt is positive, it could offer an underpinning of a positive tilt in the overall market. The other aspect to it is people tend to feel good, retail money comes in, but overall, the market focuses on that. But I do want to add another thing in terms of the historical precedents. It is very, very rare that we have 2 years in a row of the S&P 500 down. Very rare. You could go back to the 2000, when we had the meltdown in the tech sector. You could go to 2008, 2009, but, again, extremely rare. So the market looks at it and says, gee, we'll finish up this year. Already, it'll be positive. We've had such a strong November. And one other thing, too, is that active managers who have done well, who've done very well, very often will pay very close attention to the market and try to maintain those gains, even if it means locking in those gains. And then managers who haven't done well actually coming in and buying up the winners, so they can beat their index and beat their competition. So the underpinning for the end of December has a number of catalysts. That said, this week is going to be very important for the market. And I'm talking specifically about the payroll numbers. When we look at the market and we talk about, rate cuts as early as the summer, that's what, some of the folks you hear, on TV, oh no, it's not even going to be middle of 2024. It'll be the spring of 2024. Couple of issues there. One is, the Fed typically does not want to get entangled in the political campaign. Because obviously, if they offered rate cuts early on, it's going to be felt in the housing market, loans, and so on. It could help the incumbent. However, the Fed will do what it has to do if liquidity dries up in the market. And liquidity in the market is the oxygen for the market. It is the ability for the market to function properly, buying and selling. So in any event, we are going to pay attention to the economic data, and we're going to also remember that the economy is not the market and the market is not the economy. The market looks ahead. It looks ahead by many months. And I'll get to that as I finish up this call. But what I want to point out above all else is, even though the third quarter ended almost, we're going to have one more revision. I have to say that. We had the second revision last week, but it was very close to where the Atlanta Fed GDP now actually forecast where the third quarter was going to be. No one should have been surprised, because the Atlanta GDP has a very high reputation for excellent forecasting. Remember, it's fluid. So even for this quarter, the numbers coming in, it will change almost every single day, and you will have updates until you get to the end of the quarter. But the point is that, keep in mind, the economy is slowing. The Atlanta Fed GDP now actually has gone for the fourth quarter from 2.1% down into just higher 1%. They're going to have another forecast that will be printed later this week. But keep in mind, the number is coming down. It is reflected of the economy slowing. And therefore, one of the reasons that the market has done so well is that 10-year Treasury yield keeps coming down. But we want to be mindful of this. We want to be mindful of the fact that if it continues to fall, it could be reflecting a growth scare. And again, according to the Atlanta Fed GDP now, the economy is slowing. Now, slowing isn't bad at all, but we don't want it collapsing. We don't want it, just falling down, down, down. And so, again, the economic data are suggesting that the economy is slowing. The Fed Beige Book, I mentioned this in my call before, the Beige Book came out. The Beige Book is an anecdotal report from all of the banks in the territory, the Federal Reserve banks in the various territories, the various regions. And across the board, it talked about a slowdown, a muted slowdown, nothing dramatic, but certainly a slowdown across the board. What we want to see is, how deep is that slowdown, right? That's what we're trying to figure out. Or is it temporary? Is it a one-off? In terms of consumer spending, we may not have been in the malls. And I have to say this, I paid very close attention to those outlet malls as we were driving, where normally the lines were, the vehicle lines were so long that they had to bring out the state troopers, cordoning off part of the highway. I didn't see very much. And colleagues of mine have also mentioned they didn't see very much of that push, on the Friday after Thanksgiving into those outlet malls. What were we doing instead? Well, apparently we were online buying. The Cyber Monday was very strong, and that is what we're doing. Another thing that I didn't see, I don't think anyone did, that must-have. The must-have that's always on TV, where people are lining up early in the morning, a must-have toy for our children, a must-have clothing item. We must have it, and they do there's a big promotion. I didn't see that, nor did many of my colleagues who watch this. We have been spending, all right, looking for promotions and discounts, but online, that's what we've gotten used to. So we're going to pay attention to whether or not we see more of that this week. And this week is important, because I would have to say the most important element this week is on Friday, and that will be the employment report. Expectations are, this is consensus estimates of all of the analysts that come in and report what they believe is going to happen. Estimates are for 190,000 new jobs created in the month of November. Would be down from the 150,000 jobs that we had before. The expectations are that we will remain at 3.9% unemployment, and that wages, however, will tick up just a tad. Very important about the wages, obviously. Also, consumer sentiment. Believe it or not, consumer sentiment is ticking up just a bit. That's good news. But what we want to see on Friday morning, University of Michigan consumer sentiment is, are we finally starting to see that consumers are looking at inflation long-term, 1 year, and then after 3 years, 5 years, what are they seeing in terms of inflation? Very important, because the previous report suggested that they thought inflation was going to climb much higher. They acknowledged that inflation is coming down, but they were worried that inflation is going to spark up again. And that is a concern. The Fed does not want to see that, because if that continues, despite the fact that gasoline prices are coming down across the country, it means that consumer expectations are becoming unanchored. That is not what they want to see, because psychologically, if you believe that, you're going to just continue buying, because your psychology is going to be, well, it's just going to be more expensive down the road. Let's buy it now. That feeds into inflation. So let's keep that in mind. That'll be on Friday morning at 10 o'clock a.m. Eastern. Overall, though, this week, it is going to be about the labor market. Also, tomorrow, Tuesday, December 5th, let us pay attention to the Institute for Supply Management, ISM Services Purchasing Managers Index. I can't stress this enough, because we want to see it above 50. Because what is that? The line of demarcation for the largest part of our economy in expansion territory. We will also be looking at new orders, prices paid, and we will look for whether or not they plan on hiring more people. Last week, we had the ISM for manufacturing. That is still below 50, but it looks as though it's trying to bottom, which is good news. We have to pay attention to that, because I think a good portion of that had to do with the auto industry, right? Much of the supply chain got postponed because no one knew when that was going to be finished. So we'll keep our eye on that. But the largest portion of our economy is the service sector. So this week, we're going to pay attention to that. And in addition, remember, when the ADP employment report comes out on Wednesday, everyone makes it is the private sector. And that is important. We pay attention to it, but it does not mean has a direct positive correlation with what we're going to hear on Friday, because that includes government workers as well. But we do pay attention to it. The market wants to see what is going on in the private sector, and that will be on Wednesday. And last but not least, tomorrow, pay attention to job openings, because this has played into the mosaic of how we watch this economy. The Fed would like to see job openings pull back, and it looks as if consensus estimates think that is what will happen, because the more it pulls back, the more labor can't go in and demand, higher wages, a signing bonus, because it means fewer jobs, means that, if you have folks coming into the labor market, they can't go jumping around thinking that jobs are so plentiful. So we'll keep our eye on that. A lot riding on this week, by the way, a lot riding, especially, I can't stress this enough, on the labor market, because if the labor market disappoints, if the unemployment rate climbs over 4%, and if the headline number is lower than we expect, then we are going to expect, by the way, that consumer spending, 70% of the economy, is going to pull back. And that is what's going to make the headlines. So we'll pay attention to this week. Again, allow the market to rest, allow the market to digest the gains, and get ready for the Santa Claus showing up. Thank you so much. Have a good week. This material was prepared by LPL Financial. It's for general information only and is not intended to provide specific advice or recommendations for any individual. There is no assurance that the views or strategies discussed are suitable for all investors or will yield positive outcomes. Investing involves risks, including possible loss of principal. Any economic forecast set forth in the podcast may not develop as predicted and are subject to change. References to markets, asset classes, and sectors are generally regarding the corresponding market index. All indexes are unmanaged and cannot be invested into directly. Index performance is not indicative of the performance of any investment and do not reflect fees, expenses, or sales charges. All performance reference is historical and is no guarantee of future results. All information referenced in the podcast is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Securities and advisory services offered through LPL Financial, a registered investment advisor and broker-dealer, member FINRA and SIPC. Insurance products are offered through LPL or its licensed affiliates. To the extent you are receiving investment advice from a separately registered independent investment advisor that is not an LPL affiliate, please note LPL makes no representation with respect to such entity. If your financial professional is located at a bank or credit union, please note that the bank or credit union is not registered as a broker-dealer or investment advisor. Registered representatives of LPL may also be employees of the bank or credit union. These products and services are being offered through LPL or its affiliates, which are separate entities from and not affiliates of the bank or credit union. Securities and insurance offered through LPL or its affiliates are not insured by the FDIC or NCUA or any other government agency, not bank or credit union guaranteed, not bank or credit union deposits or obligations, and may lose value.